Welcome to this deep dive on funding a PhD by leveraging a period of high income. We will cover aggressive saving, a controversial but legal tax strategy known as the Roth-conversion during low-income years, how to build liquidity and buffers, and a reality check on PhD timelines. We will tie this all together with diagrams, a concrete step-by-step plan, and a quick quiz to reinforce learning. Let's begin. First, we will set the stage for why your pre-PhD earning window is your most powerful lever. Then, we will move into the tax arbitrage idea of contributing pre-tax while income is high and converting to Roth during low-income student years. Next, we will discuss liquidity rules of thumb, emergency funds, high-yield savings, and buffers for the unknown. After that, we will analyze whether a PhD is the right move compared to alternatives. Finally, we will build a concrete step-by-step plan and test your understanding with a quick quiz. Before we proceed, this content is educational only and does not constitute financial, tax, or legal advice. Everyone's situation is different. Please consult a qualified professional who can review your specific details, especially before executing tax-sensitive transactions like Roth conversions. To guide you through, here is our roadmap. We will start with the rationale for aggressive saving now. Then, we will explore the tax arbitrage strategy of contributing pre-tax while income is high and converting to Roth during low-income years. Next, we will dive into liquidity and buffers using high-yield savings and an emergency fund. We will then evaluate whether a PhD is worth it in your case. After that, we will outline a practical action plan. Finally, we will solidify learning with short quizzes. Now let's explain why aggressive saving during your high-income window is so powerful. Your current compensation allows you to maximize contributions to tax-advantaged accounts, directly reducing taxable income. Then, in your upcoming low-income years as a student, the tax brackets may allow Roth conversions at low or zero marginal rates. This sequence can significantly reduce lifetime taxes. Simultaneously, because you will need cash within 3 years for moving, tuition gaps, and unexpected delays, you should keep near-term funds in low-volatility vehicles like high-yield savings. Finally, you must build a stipend-level budget now to avoid underestimating expenses later. Let's detail the tax arbitrage. While you are earning a high salary, maximize contributions to a traditional 401k or 403b to reduce current taxable income. After transitioning to your PhD, your taxable income may drop dramatically. During those low-income years, you can convert pre-tax dollars to a Roth IRA. If you keep conversions within the standard deduction and the lowest tax brackets, you may owe little or even zero federal income tax on those conversions, effectively shifting tax liability from high-rate years to low-rate years. However, confirm employer plan rules for rollovers, understand the pro rata rule if you hold after-tax dollars in IRAs, account for state tax differences, and consider staging conversions across several years to smooth tax exposure. This flowchart walks through the life cycle: contributing pre-tax while income is high, transitioning to a lower-income PhD phase, potentially rolling over a 401k to a traditional IRA if the plan does not allow in-plan Roth conversions, and then executing annual Roth conversions sized to fit within the standard deduction and lowest tax brackets. Decision diamonds remind you to confirm rollover permissions with the plan administrator and to factor in state tax exposure. The outcome is a pool of Roth assets that can grow and be withdrawn tax-free in retirement, assuming rules and holding periods are met. Next, we turn to liquidity. Funds needed within 3 years should stay out of volatile markets. Prioritize high-yield savings accounts for quick access and predictable value. Size your emergency fund to 6 to 12 months of expenses calculated at your future stipend level, not your current salary lifestyle. Segment buckets for moving costs, tuition or fee gaps, and any special needs like travel or immigration-related expenses. Automate transfers into these buckets, and maintain a small extra buffer to prevent forced selling during market downturns. Now let's convert strategy to action. Start by creating a stipend-level budget, including housing, utilities, food, transportation, healthcare, and discretionary categories. While still earning a high salary, maximize traditional 401k or 403b contributions. If your plan offers a mega backdoor Roth, assess whether it fits with your goals and understand pro rata implications. Ensure you have a Roth IRA set up and maintain clear records of contributions and conversions. Determine whether your 401k allows direct in-plan Roth conversions or if a rollover to a traditional IRA is necessary. Then, set an annual Roth conversion target that fills only the standard deduction and the lowest tax brackets during your student years, revisiting as your situation evolves. Simultaneously, build HYSA buckets for emergency reserves, tuition or fee gaps, moving costs, and a flexible buffer. Review your insurance coverage to reduce catastrophic risk. Finally, create calendar reminders to reassess conversions annually, and document contingency plans if your program extends longer than expected. Here is an illustrative stipend-level monthly budget. We assume $3,000 net income. Rent and utilities are $1,200, groceries $350, transportation $150, health-related costs $200, phone and internet $90, discretionary spending $250, emergency fund contributions $400, tuition and books reserve $200, and a buffer of $160. Adjust these figures to reflect your market, benefits, and lifestyle. The key is to validate that your cash flow supports your reserves without relying on high-risk investments. Let's compare the PhD path with alternatives. On the pro side, a PhD offers research depth, access to academia or advanced R&D roles, possible fellowships, and the personal satisfaction of scholarly work. On the con side, the opportunity cost can be significant, with 4 to 6 or more years of lower pay, potential stipend variability, and relocation or timeline risk. Many industry roles in computer science and mathematics accept a master's degree plus experience, which may provide faster earnings growth. Evaluate net present value, job market demand, and your intrinsic motivations before committing. Moving on to timelines, plan for 4 to 6 years rather than an optimistic 2 to 3. Stage Roth conversions across multiple low-income years to keep taxes minimal. Maintain optionality by sustaining a buffer that allows a return to industry if needed. Revisit your savings glide path and conversion sizing annually as research focus, funding, and living costs evolve. Quiz time. Which statement best captures the tax arbitrage strategy discussed? Option A. Contribute to Roth accounts while income is high. Then convert to traditional during the PhD. Option B. Contribute to traditional while income is high. Then convert to Roth during low-income years. Option C. Avoid all retirement accounts to maximize liquidity before the PhD. Option D. Only use taxable brokerage so you can sell anytime. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to contribute to traditional accounts while income is high, and then convert to Roth during low-income years. This approach shifts taxable income from high brackets to low brackets and can result in minimal taxes on the conversion, leading to tax-free growth thereafter, assuming rules are met. Second quiz. For funds needed within the next 3 years, what is the recommended approach? Option A. Invest aggressively in equities for higher returns. Option B. Hold in a high-yield savings account and avoid high volatility. Option C. Convert everything to Roth immediately regardless of tax bracket. Option D. Borrow on credit cards to preserve investments. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to hold funds needed within 3 years in a high-yield savings account and avoid high volatility. Short-horizon cash should prioritize principal protection and liquidity to avoid sequence of returns risk. Here are the key takeaways. First, your pre-PhD earning window is your strongest lever. Second, make traditional contributions now and consider Roth conversions during low-income years if tax brackets and rules align. Third, maintain 6 to 12 months of stipend-level expenses in high-yield savings and segment near-term goals. Fourth, plan for a 4 to 6 year PhD timeline. Finally, preserve optionality with an exit plan and regular reassessment. To wrap up, save aggressively while your income is high, and aim to optimize taxes via Roth conversions during your low-income student years. Keep near-term cash safe and liquid, and pressure test the financial return of a PhD against alternatives like a master's degree plus industry experience. Follow the action plan we outlined, and revisit it annually as circumstances change. Thank you for watching. If this was helpful, please like the video, share it with someone considering graduate school, and subscribe for more content on smart financial planning. I would love to hear your plan in the comments. Are you pursuing a PhD now or later, and how are you preparing financially?